In today's episode, I'll talk about two interesting stories. In the first story, I'll discuss how the US Fed's interest rate cuts affect India. And in the second story, I'll discuss how the Indian government is suddenly very interested in including quick commerce data as part of the GDP calculation. Welcome to the Daily Brief Show by Zerodha, where our aim is to give you news that is one level deeper as compared to regular news channels. I'm your host Anurag Bansal. Today is Thursday, the 19th of September. Let's start with the first story where I talk about how the US Fed interest rates affect India. See, a few weeks ago, Jerome Powell, who is the head of the US Federal Reserve, dropped a hint that they might be cutting interest rates very soon. He said, and I quote, "The time has come for policy to adjust." Now, this was basically a soft signal that a Fed interest rate cut might be on the horizon. Now, fast forward to yesterday night's Fed meeting. By the time you're hearing this, they might have already made their call on interest rate cuts. Now, I've talked about Fed rate cuts and inflation quite a bit on this show by now. So I'm guessing you probably at least have a rough idea of why decisions like this are a big deal, not only for the US, but for everyone around the world, including for us here in India. So today I wanted to dig a little more deeper into what has been happening in the US and how their decisions are spilling over to affect the rest of the world, including India. See, since early 2021, inflation has been a major pain point in the US. The pandemic messed up global supply chains and made it very hard for companies to get the stuff that they needed. At the same time, the demand for goods was shooting up because businesses and people were trying to bounce back. Now, to top it off, the government pumped a lot of money into the economy in order to help things out, and this boosted spending even more. So, with high demand and low supply, prices shot up, which is classic inflation. Now, to fight this, the Fed started raising interest rates in 2022 and 2023. The idea was to make borrowing more expensive so that people as well as businesses spend less, which could hopefully cool down inflation eventually. And this seemed to have worked, but only partly. See, although inflation eased up, the other parts of the economy like job growth began to slow down significantly. Now, to understand why all of this happened, we must understand exactly what happens when the Fed cuts interest rates. Whenever the Fed cuts interest rates, borrowing becomes cheaper. It is as straightforward as that. For businesses, it means they can borrow money at a lower cost, which encourages them to invest and expand even further. For regular people like you and me, this means mortgages, car loans, credit card debt, etc. all get a little less expensive. So spending tends to pick up even further. And more spending gives the economy a big boost. But there is also a flip side to this, which is very relevant to us in India. See, rate cuts can weaken the US dollar, which actually works in favor of emerging markets like India. And this is because we as a country often borrow in US dollars. And the weaker the dollar gets, it makes it easier for us to pay off those debts because it effectively costs us lesser. Now, talking about this specific rate cut cycle, it is very different from the past ones like what we witnessed in the year 2000 and 2008. In the early 2000s, high levels of corporate debt, especially in the tech sector, played a very important role in the dot-com bubble crash. A big part of why this happened is because the Fed started to raise interest rates in 1999 in order to cool down the economy, which contributed to the bubble bursting. After that, the Fed started cutting rates in order to stabilize the markets. In 2008, it was housing debt that led to the financial crisis. Years of low rates had fueled massive borrowing in the housing market, especially subprime mortgages. When that bubble burst, the Fed responded by slashing rates aggressively in order to prevent a complete economic collapse. But today, 2024 is very different. US households and businesses are not carrying as much debt as they were in those previous cycles. Household debt, particularly mortgage debt, is much more manageable and businesses are not as highly leveraged as they were in 2000. And this is why this cycle feels so different. Even if the Fed cuts interest rates today, we are no more dealing with the same financial imbalances that we used to in the past. But that said, the biggest and the most important question for us as Indians is, how does all of this even affect India? See, India's central bank, which is the RBI, usually monitors the Fed's actions very closely. While they set rates based on the country's economic performance, there is also a ripple effect in the picture. So whenever the Fed cuts or raises interest rates, the RBI mostly tends to follow it. This impacts Indian markets, including things like stocks, bonds, and even the Indian rupee. All these instruments react very strongly to changes in the US monetary policy. So if Fed cuts interest rates, Indian asset classes, especially sectors that depend on global capital flows, also tend to witness a positive boost and vice versa. But as a conclusion, even though it is very tempting to look at past rate cuts for clues of what the future would look like, the global economy today is very, very different from how it has ever been in the past. As I already mentioned, there is less private debt in the US, inflation is structurally higher, and we are still dealing with the aftermath of the pandemic. Predicting how the markets will react to this rate cycle is very, very tricky. Moving on to the second story, I'll talk about why the government is suddenly so interested in quick commerce. See, as we all might already know, quick commerce is very quickly becoming a big part of how we shop these days. In fact, the space has grown so quickly that today quick commerce makes up about 5 to 6% of what households spend on grocery, according to estimates cited by Economic Times. Now, this growth is not only changing the way we shop, it is also catching the government's attention. The government is monitoring quick commerce very closely. They are analyzing data from platforms like Zepto, Blinkit, Instamart, and Big Basket to look at how people are shopping and what people are buying. Now, I'm sure the first question in your mind is, why are they even doing this? See, that is because quick commerce has really exploded ever since the pandemic happened, and now it makes up almost 40% of online grocery sales in the country, according to the same ET source I told you about earlier. Now, the government is thinking about using this quick commerce data in order to help calculate the country's GDP and track economic growth. This data could give us a clearer picture of how people are spending their money in today's modern world where fast online shopping is almost becoming the norm of sorts. By the way, as a side note, if you want a deeper dive on this topic, do check out our episode which is titled Who Will Win the Quick Commerce Wars, which is linked in the description below. Now, back to the story. Another thing the government is curious about is dark stores. To explain it very simply to you, dark stores are basically very small warehouses that are set up in busy neighborhoods in order to make super fast deliveries possible. Recently, senior government officials sat down with an executive from one of the leading quick commerce companies in order to understand how these dark stores operate, especially in relation to India's foreign investment rules. Also, if you've been following the news lately, you might remember that Piyush Goyal recently made some very sharp comments about Amazon. He criticized the company for trying to find loopholes in India's foreign investment rules. Mr. Goyal said that such practices harm smaller companies and businesses and disrupt fair competition by giving bigger companies like Amazon a very bad unfair advantage. Now, with quick commerce booming so quickly, the government basically wants to ensure that companies like Zepto, Blinkit, etc. are not pulling out the same tricks from their hat. The government wants to watch very, very closely to see how these companies are setting up and also managing their dark stores in order to ensure that no one is playing around with the rules. Now, that's more or less about the government story. But while we are on the topic of quick commerce, I thought it'll be a great idea to update you all with some new movements happening in this space in a very few quick points. First, Flipkart recently launched its 10-minute delivery service called Minutes. It is now racing against Zepto, Instamart, and Blinkit. Flipkart plans to launch as many as 100 dark stores before the festive season begins this year, so they're extremely bullish about this space. Second, the ex-CEO of ClearTrip is launching a new venture that is focused on quick deliveries of premium products. Third, Zepto is trying something new with a feature called Super Saver. This is a service that is aimed at budget-conscious shoppers who like bulk shopping. Their hope is to push their average order value or AOV higher with this feature. Fourth, Myntra is also jumping into the quick commerce space with a 4-hour delivery service. This means quick commerce is now also making its way into categories like fashion, which have very high return rates. Next, Blinkit and Zepto are testing out quick returns and exchanges for fashion e-commerce. Their goal here is to make their customer experience smoother and more efficient. Next, Big Basket, which was known for its scheduled delivery slots, is now investing very heavily into quick commerce. They're planning to boost their dark store count from around 400 to 700 by FY 2025. Now, a big part of the reason why there is even more buzz around quick commerce right now is the upcoming festive season when sales are high across all categories. So all in all, with the kind of wild growth that quick commerce has seen lately, the lines between quick commerce and traditional e-commerce has started to blur out very quickly. However, quick commerce still has a long way to go in many categories. Moving on to the final section of the day, which is the small news tidbits. First, India has surpassed China in the MSCI Investable Market Index for the very first time, thanks to the strong stock market performance and China's economic struggle. This shift may attract more institutional investment into Indian companies, although market volatility could lead to future shifts once again. Second, Lenovo's Pondicherry plant will produce 50,000 AI servers and 2,400 high-end GPU units annually, with 60% for exports to Asia Pacific region. Additionally, Lenovo is launching a new AI-led R&D lab in Bangalore as part of a $1 billion AI innovation investment over the next 3 years, which is supported by India's PLI Scheme 2.0. Third, Urban Company is preparing for an IPO next year with investors restructuring their capital. Recent secondary transactions include Titan Capital's founders selling shares worth 400 crore rupees to Dharana Capital. Key investors like Steadview and Elevation are also looking to sell a part of their stakes, potentially unlocking 100 to 150 million US dollars in liquidity. Fourth, Ease My Trip has acquired stakes in P-Fledge Home Healthcare and Rollins International in order to enter the medical tourism market. This market is currently valued at close to 8 billion US dollars. Now, this move strengthens its position in serving travelers looking for medical and wellness treatments abroad, which enhances its role in the travel and tourism industry. Fifth, Hindustan Unilever Limited is launching its new luxury beauty brand called Hourglass in India. This is to capitalize on the rising premiumization trend. With the surge in consumer spending on high-end products, HUL is aiming to compete with global luxury brands and increasing its market share in India's growing premium beauty segment. That's all the news and stories I have for you today. I hope you found value in today's episode. By the way, a quick announcement before we end this show. We've recently introduced a new Hindi channel where we talk about the same stories but in Hindi. So do make sure you check it out if Hindi is the language of your preference. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.